Okay, welcome back everyone. So just before we continue with learning unit 4, I just want you guys to note in your diaries what your assessment dates are that you need to be aware of. Okay, so the first one is on the 26th of April, you have to submit your assignment. Now your assignment will be loaded on the student portal, and then you will also have a link up there to upload it. You will see there's an assessment time at 9. That means your assignment needs to be submitted on the portal before that time and date. Otherwise, it will not be marked. And then on the 9th of May, you have your test 1. So that is where you're physically going to sit and write your test. It is at 11. It will be 60 minutes. And that will normally be based on learning units 1 to 4, potentially 5. I will just check your module outlines and confirms what we are writing about. In the event that you are sick, there would be a replacement test on the 23rd of May to replace that. And then your exam currently is scheduled for the 20th of June at 8 a.m. Okay, so on the portal, they will also upload this. If there's any changes that are made, you will find it there. So always just go refer to the portal. That is where you would find the latest version. Okay, so let's look at question 4.3. So what we're going to do in this question is I've done the transaction that they've recorded already in here. So what they tell you is Omega Traders, a computer retailer, entered into the following transactions during June. The business is a registered VAT vendor and trades only with other registered vendors. They use a perpetual inventory system. Okay, who can tell me when you see the words perpetual inventory system? What does that tell you? Where should I take the inventory to? Okay, you remember in Learning Unit 2, we discussed there's two types of inventory systems, a perpetual one and a periodic one. Who can tell me what was the difference between the two? Okay, so Lesedi asked me to repeat the question. So who knows what is the difference between a perpetual inventory system and a periodic inventory system?
Ma'am?
Yes.
Doesn't the perpetual one involve if it's a if it was done through a cash sale, wouldn't it involve the four accounts, which is trading stock, cost of sales, trading inventory, and then if it's a
Yes, you're on the right track, yes.
periodic, it only involves trading stock. It only involves the two accounts that are trading inventory and the sales.
Okay, no, so there you don't have it 100%, but you're on the right track as to what the difference are. Okay, so what he said is perpetual. When we do perpetual, we take it to trading inventory, trading stock, or inventory. Now remember, perpetual inventory system, we account for the inventory when we acquire it as an asset. Okay, so let's quickly look at this transaction here at the bottom. So they tell us we purchased 8 Mabello color desk printers at 4,000 Rand each, excluding VAT. So the VAT has not been accounted for. as well as 4 color printer cartridges of 80 Rand each. Okay, on credit from Troy's Toys and received invoice number CI622. These were all purchases for resale purposes and have not reached the credit limit. Okay, now because we say we're a computer reseller, if we buy computers and cartridges, that is seen as our trading stock. Now, on the perpetual inventory system, what that would mean is when we account for it, we would debit the trading stock account. So we're taking whatever we've purchased to our trading stock account, which is an assets account. Yeah, you can see it's an asset. Okay, because we purchased it on credit, we credit the creditor's control, which is the liability. Now remember, the liability would be inclusive of that. Okay, whereas the asset you purchase would be exclusive, or the expense would be exclusive of that, and then we account for the input VAT. Now we know it's input VAT because I purchased it, so I would be able to claim that VAT back. If I can claim it back, it is an asset for me, and assets increase on the debit side. Okay, so let's quickly see what comments have I made here. Oh, sorry, I see the calculation should be 4,000 multiplied with 8 plus the 80 times 4. So I'll just correct the slides when I send them out. So it's 4,000 times 8 plus 80 times 4 will give you the asset purchase price. And then your VAT would be this amount that you've calculated, multiply with 15% would give you the VAT. Because remember, this amount does not have VAT in it, so it represents the 100%, which is at the bottom. What we have, I want the VAT, which is 15, so that is at the top what I want, and then you work out the input VAT amount, and then the liability would be just the sum of the two. So your liabilities will always be the VAT inclusive amount. So what do we have to pay our supplier? Okay, Zandile asked, what type of account is VAT? Okay, Zandile, that's a very important question that you're asking there. So remember, we've got two types of VAT accounts. We've got input VAT, we've got output VAT. Now in this scenario, input VAT, because of the fact that it is money that I am asking from SARS, so I'm asking for a refund, it is an asset account. And the account name would be input VAT. Whereas if I make sales and I have to pay the VAT over to SARS, we call that output VAT. And because I still owe SARS the money, that output VAT would be a liability account. Okay, so input, asset, output, liability. Sandile, does that answer your question? Okay, so let's continue then. So what I want you guys just to do is on a piece of paper, just write down that all goods were marked up at 60% above cost. Okay, so just make a note of that on your pieces of paper because we'll need that information a little bit later. Okay, so now what we're going to do is we are going to try and record transaction number 4 and transaction number 9. So I'm going to give you 5 minutes just to read through it and see if you can figure out what account is being debited, what account is being credited, and then if it is an asset or liability or owner's equity account that it relates to. You are welcome to ask me questions. If you're unsure about anything that you see on the screen currently, then we will discuss it. So I'm going to give you 5 minutes. Just read number 4 and number 9 and see if you can figure out where this information should go to. Okay, so do you guys need a few more minutes before we discuss point 4 and point 9? Okay, so I'm just going to stop sharing this and then I'm going to share a PDF file so that I can make notes on there as well. Okay, so let's go through the transactions and then identify what did you guys have to see to be able to capture the information in the format that they've asked for. Okay, so the format they asked for is they want you to indicate the document number, whether it's original or duplicate item, what journal will it go to, and then what account is being debited and credited, and then is it an asset, owner's equity, or liability. Okay, so let's look at the first one. So we purchased the following from petty cash. Okay, so we purchased it from petty cash and PCB 17 was issued. Okay, so what are they basically telling us here? This is the journal which we will use. So remember, we did it from petty cash. So we know that any type of petty cash information will go to our petty cash journal, which we abbreviate as PCJ. Then they tell you, for the purchases, we've issued PCV 17. Now this is your document, your source document or document number. Okay, so this is the document number you're going to use in your table. Now let's see what have we acquired. Okay, we got 4 paper reams at 22 Rand each, 3 lever arch files at 21 Rand each, and all of these excludes VAT. Okay, because of the fact that we are VAT vendor, when we do this transaction, we will have to account for the expense. So we are going to have an expense account, which will generally be your office stationery or stationery in this scenario if we look at what they've purchased. Okay, so stationery. Now remember expenses, we said increase on the debit side. So we are going to debit your stationery account with the value that we calculate here. Then we need to calculate the VAT separately. Now because it's an expense, the VAT will be input VAT. And because of the fact that we paid it out of petty cash, we would credit the petty cash amount, but with the amount inclusive of VAT. Okay, so remember when you buy it, you would have paid the VAT over to the supplier when you purchased it. So that means that your petty cash amount would include the VAT amount. So let me just say here, debit. Okay, let me just make this debit stationery. Okay, and just right here, this is the amount excluding that. Okay, just so that you guys know what amount you need to account for. Now let's go capture it on the Excel file. Let me just stop sharing here and then share the Excel file with you guys. Oh, what is happening here? Let me try again and see if it wants to work now. Okay, that stopped flashing. That's a good sign. Okay, so we said on the 4th, the document number, based on the information we read, was the PCVR 17. So that is what you would fill in under the document column. Okay? Okay, wait. Did I skip a transaction? Oh, I went straight to the 9th. Okay, so I skipped the transaction on the 4th. So let's do the transaction on the 9th and then we'll piggyback to the 4th. Okay, so the PCV 17, that is our document number. Now, if I pay something out of petty cash, what document would I have, the original or will I have a duplicate that I need to account for in my records? What do you guys think? Do we have a duplicate or do we have an original? Okay, so Lino says original. Well, that's correct because remember, you deal with your petty cash, so it would be original document. Okay, let me just make that so that you can see it. Okay, what is the journal number that we are going to capture this information in? So what's the abbreviation for our petty cash journal? Okay, that's correct. PCJ. So petty cash journal is PCJ. Okay, now we have to do the accounts we are going to debit and credit. So I said the first account we are going to debit is our stationery account. So that is the account where we capture the stationery amount. Okay, and we said that amount will be exclusive of that. Now, under which category will I account for the amount for the stationery? Sandile says owner's equity. That is absolutely correct. Sandile, do you think the owner's equity will increase or decrease with the amount of stationery? Decrease. That is absolutely correct, guys. Okay, so let's show you how to work it out. So if you look here at the top formula bar, okay, let me maybe just type it here at the bottom of the screen. Let me insert a line item here. Then we'll just add the calculation. Okay, so how I worked it out is we said we had 4 paper reams of 22 Rand each, and we had 3 lever arch files of 21 Rand each. Now remember, this amount is the one excluding that. So it's before we've added the VAT amount. So that is how I got to the 151. Okay? So this is the calculation. Then we said we are going to credit. We purchased it through petty cash. So petty cash is what we are going to credit. Petty cash falls under what category? Is it an asset, owner's equity, or a liability? Okay, so where does petty cash, under which category would you include petty cash? Okay, Lesedi says it's an asset, Lino says it's an asset. That's absolutely correct. Now, remember what I said is I said petty cash would be the amount inclusive of that, whereas we said stationary currently is the amount excluding that. So we will take this 151 that we've calculated, and then we have to go add that onto it. So we are going to multiply it with 115. So I want the amount inclusive of that, and I'm going to divide it by 100, which is the amount excluding that, which will then give me, let's do this, an answer, or it should give you an answer of 173,65. Okay, but now you can see we're not balancing. So we've got a 173 on the left side, but if we look at owner's equity plus liability should also agree to the amount. But there's a difference. Where will the difference go, guys? Where do you think are we taking the difference? Okay, so if we look at what we've captured to stationery and we've looked at what we've captured for petty cash, what is the difference? Okay, Zandile says it's input VAT. Yes, Zandile, that is correct. So now we know we have to debit the input VAT. So remember, if we credit it with 173, your debit needs to equal what you credited. So currently the credit is bigger than the debit, so I would debit the input VAT. What will I debit the input VAT with? What amount? With what amount will I debit the input VAT? What is the value that we will capture in this table? Come on, guys. What do you think? What do you think is the answer? Okay, so Zandile says the difference between the stationery and the petty cash. Yes, that's absolutely correct. Okay, next question. Input VAT. What type of account did we say it is? Is it an asset, owner's equity, or liability account? Okay, Refilwe says it's an asset account. Okay, yes, Lesedi, Mkhubele, yes, absolutely correct. It's an asset account. Okay, so if the answer is the difference between the stationery and petty cash, will we increase the assets or decrease the assets? So are we going to show a positive amount or a negative amount in our table? Okay, Lesedi, positive. That's absolutely correct. So we are going to show an amount of 22,65, which is the difference between these two amounts. Okay, now how do I actually know that I am balancing? Let me quickly show you. So if I create this orange, so I'm going to add these two together. So I take this cell and I add the other cell. Now remember, the ones are negative, the ones are positive. Then I get a negative 151. Okay, so now I know the net effect of the assets is a negative 151, and that equals the negative owner's equity of 151, and liabilities would be 0. So can you see this is how you balance a transaction as soon as VAT comes into play? Okay, now this is where a lot of students go wrong. They forget this line item here. One. Secondly, the symbol. They do the symbol incorrectly, or they put input VAT as a liability as opposed to an asset. Okay, so those are the most common things students do wrong when it comes to the input VAT. So I want you guys to make a note so that you don't make a similar mistake when you do your test. Okay, let's go back to the question then. Okay, I accidentally skipped number 4, so let's do number 4 now. Okay, so number 4, we said we returned one faulty VX56 cartridge. Okay, so that is based on the previous information, which was here, that we bought from Troy's Toys and received a credit note. Okay, so we got a credit note. The necessary authorizations were obtained for this credit note. Okay, so remember we had CI622. Okay, now let's quickly see what do we have to capture. Okay, so we know it's a return when we return something we purchased on credit. Okay, so sorry, just delete that. Okay, so the first entry we said went to creditors journal. So we said if we purchased something previously on credit and now we're returning this will go to your creditors, sorry, let me just spell it correctly, creditors allowance journal, which we abbreviate as CAJ. Okay, and the reason it goes to this journal is because of the fact that the original transaction was captured to the creditors journal. Okay, so if you were unsure about it, this is how you would know which one of the DAJ or the CAJ you would use. Okay, now they don't tell you on here what the credit note number is, so I'm just going to fill it in. This is just an error on a typo, so it was CN22. That is your credit note number. Okay, let's see what other information may we require. Okay, so we returned one of the faulty cartridges. Now remember, in the original transaction, the cartridges was captured to our trading inventory because of the fact that we've got a perpetual inventory system. So if I return something, my trading inventory will now reduce. And the creditors control, which was the account that I purchased it on, will also decrease. So I'm going to debit my creditors control and credit my inventory amount. But now I also need to remember that there was VAT on that creditors control amount. So I need to include the VAT amount to get to the correct amount. Okay, so let's go fill it in on our Excel sheet. Okay, so we said the first one is CN22 is our document number. Okay, when you get a credit note from your supplier, is it an original or a duplicate in credit note? What do you guys think? Original or duplicate? Okay, Zandile thinks it's original. Anyone else? What does the rest of you think? Okay, so Lesedi says original, Refilwe thinks a duplicate, Okule, original, Maria, original. Okay, so in this scenario, it is actually original. It would have been a duplicate, Refilwe, it would have been a duplicate if we issued it to our customer. So remember, originals is anything we receive from our suppliers. Duplicates is any document where we issued the document, we would keep the duplicate. Okay, so that's how you remember it. Okay, so we said this transaction will now be reversed because we are taking one of the items back. Okay, if I take something back, we said it goes to your creditors allowance journal. So your journal number here is CAJ. Okay, now if I credited creditors control in the previous transaction, what will I do with it now in this entry? What is going to happen with the creditors control account? Am I going to debit or credit it? Okay, let me repeat this. If I return something to my supplier, am I going to increase or decrease what I owe them?
Decrease.
Okay, so we're actually going to decrease what we owe the supplier if we send something back. Okay, now remember we said if you think on that dead click I explained in class, we said we credit liabilities. Now remember liabilities, creditors control is in there. So on the credit side it would increase. That means on the debit side, that creditors control account will decrease. Okay, now what value will we decrease it with? Going to add a line here so we can do the calculation for you guys. Okay, so let's quickly see what was the information again. Let me just open the PDF. Okay, so we returned one faulty cartridge. So remember the cartridge was 80 Rand each. Okay, so we know it was 80 Rand each and that was excluding VAT. So then to work out how much my creditor will decrease, remember we said creditors control would be inclusive of that. So we take that 80 Rand, we multiply it with 115 over 100 to get to the correct value. Okay, but we also said that we are going to decrease the liability. So it's a negative amount. So you would then reduce what you owe your creditor, 92 bucks. Okay, now if I return something, we are also going to decrease the trading inventory, similar account there. Okay, so you see same accounts here. I'm just going to do this so that you can see the account names are exactly the same if I return something. Okay, so trading inventory we know is an asset account, and we said it would be excluding VAT. So the amount exclusive of VAT will be accounted for under the asset. Okay, now this is where you guys need to listen carefully. When I return something to a creditor, the VAT account name changes. So it is deemed as if I've sold it now. So I will take it to output VAT. So I'm going to highlight this in, let's make it orange so that you can see it's changed. So let's make this orange just so that you guys can see. Initially we claimed input VAT, but when I return it, SARS deems it as if you sold it back for VAT purposes. And then you take it to output VAT, and the net effect would be 0. Okay, if it happened over different months, you would just account for it in different months, where one you would pay the money back to SARS, or the other one that you would claim the money. Now remember, that is the VAT component. Now, who can tell me? Output VAT, is it an asset, owner's equity, or liability? Okay, let me repeat that. Output VAT, asset, owner's equity, or liability? A liability, yes. Thank you, Refilware. Okay, now we know we've got 80 for trading inventory. We've got 92 for liabilities. So if output VAT is a liability, we will put the 12 Rand, which is the difference between the two. But now remember, we need to balance it. Now, because of the fact that we have to pay it over to SARS, this would be positive. And then if I add these two together, so let's just make this a light green, just to show you. So if I add the negative 92 with the positive 12, I get a negative 80. And this is how I know it balanced to the asset side. So I've balanced the equation. So if you get into a test and you are unsure whether it's a positive or negative, then go look at this equation. Whatever's on the left-hand side, the assets, need to equal what the owner's equity and the liabilities are. So if this is bigger than the 80 there, then you know you have to put an opposite symbol to get to the same value. Okay, so this is how you do this when you get to a test or in an assignment. Okay, before we move on to the next transaction, do you guys have any questions on this? Do you have any questions? Are you still with me? Are you okay? If you don't have questions, just put whatever emoji you feel explains your current mental state. Okay, so it looks like everyone's fine for now. Okay. We won't be able to finish this today, so this will be homework. When you go through this at home, and there is something you get stuck on, you are welcome to email me, and I will explain it to you, and I will also show you the calculation if needed. Okay, so let's do one more transaction before we finish all for today, because I think that's all that we would have time for. Okay, so now we say we are selling 8 color laser printers to Peter's Goodies. So this is our customer on credit. Okay, so we're selling it on credit. That means this is a debtor. So as soon as we see credit and a customer, we know debtors journal. And the account we will take it to is debtors control. Okay, so you see debtors journal, debtors control, they go together. Okay, so then they tell you it's 5,750, but let's see if that's included or not. Yes, it includes VAT. So this is the value that our customer will have to pay us. So this is the amount that the debtor owes us. We issued invoice TI or T130 for this purpose. Okay, now debtors journal, the abbreviation for that one is DJ. Just to put it in here so that you guys have it. Okay. So let's go see how do we actually capture this now on our Excel sheet. Okay, so the first entry, remember when we do perpetual, when we sell something, we have to do 2 entries. We have to account for the sale, which is the first entry, and then the second entry is where we remove the inventory from our trading inventory to reduce our stock on hand, and then we take it to the cost of sales account. So we're going to start with the one all of you always get right. We'll start with the sales, and then we'll do the one where most of you forget about this transaction. Okay, so the first thing is, what document number did they give us? So let's quickly see. So in here, we issued invoice T130. Okay, so that means the document number for this transaction will be T130. It will be the same document number for both transactions. Okay, do we keep an original or duplicate when we issue a transaction to a supplier, to a customer? So if I sell something, will I have the original or the duplicate in my business? Okay, duplicate, that's absolutely correct. So we will have a duplicate, yeah, because of the fact that we gave the original to the customer. Okay, so our journal number, we know this is a debtors journal because of the fact that we sold it on credit. Okay, so now let's start with the first transaction, the sales. Now, because it's on credit, have I received the money yet? No, so we haven't received the money as yet. So that means we will debit debtors control because we haven't received the money. So we don't take it to bank if we have not received the cash. Okay, so debtors control. We are going to credit. Remember, we sold it, so we're crediting our sales. Okay, now let's start with the debtors control. If we look at this information, we sold it for 5,750 Rand, and that was including VAT. We sold 8 of them. Okay, so that means, let me just put a line in here. So debtors control is an asset. So we've got, let me just make that. Okay, so it's 5,750 and we sold 8 of them. Okay, so that is how you would calculate the debtors control, so the sales value. And it will give you an amount of 46,000. Okay, but now remember the sales value will be the amount excluding VAT because of the fact that we have to pay the VAT over to SARS. Now, sales is owner's equity. So how we calculate that, excluding VAT, we take the 46,000, which is what our debtor owes us, and then we say, okay, we want the amount excluding VAT, so we want the 100, and we currently have the 115 amount. So the amount includes the VAT, which will then give you an amount of 40,000. Okay. Now, what type of VAT are we documenting in here? Is it input or output VAT? If I sell something, do we account for input or output VAT? Okay, so I see all of you say input VAT. Okay, remember input VAT is when I paid something, so it's an expense. Here is where I made a sale. So in this scenario, it is output VAT because I made a sale. I need to pay the money over to SARS, which is a liability. Now, it's the difference between these two. Now, because of the fact that the owner's equity is lower than the asset on this side, our output VAT would be the 6,000, and it would also be a positive in this scenario. Okay, so I'm just going to discuss the removing the inventory, and then we are going to call it a day for today. Okay, so let's quickly see. We have debit the cost of sales. We are going to credit the trading inventory, with that amount. And then we need to do what still? Do we need to do anything else? Do we have to put VAT on that transaction? No. So remember, the trading inventory will be the amount excluding VAT. So we do not actually have to show it, do not have to account for the VAT. Okay, but now how to account for the transaction? Okay, so we said the sales amount is 40,000. Now remember, we said the markup is 60% on cost. So we take the 40,000. We want to work out what is the cost price. So cost price would have been 100. The markup would have been 100 plus our profit of 60, which is the sales price, which is the 160. And that is how you would calculate the cost of the inventory that we sold. Okay, when you do that calculation, we would decrease our inventory with 25,000, and we would move that exact same amount to owner's equity, which is the cost of sales account, which is an expense account. Okay, very important for this transaction, where we move it from trading stock to cost of sales, there is no VAT on that specific transaction. Okay, so we are, let's just move to, okay. So for your homework, I want you to complete question 4.3. I'm going to send you in the email the PDF with the questions. So I want you to do that for homework. If you've got a textbook, I want you to work through example 4.1 on pages 115 to 121. That explains the journals that we will be dealing with. So it's got a very good example of how to draft your cash journals and all the different transactions, and it shows you how to capture all the information. And then based on that, if you've got time, I want you to attempt question 4.5, which we will then discuss next week in class. Okay, do you guys have any questions for me? Is there anything that you are wondering about?